Greetings, savvy investors and curious minds. Welcome to InvestorWeb, your go-to channel for all things finance and investment. Here at InvestorWeb, we aim to demystify the world of finance, breaking down complex concepts into digestible, actionable insights. Whether you're a budding investor or a seasoned pro, our videos are designed to enlighten, inform, and hopefully help you grow your wealth. Today, we're cracking open a topic that's as intriguing as it is controversial. Ways rich people avoid paying taxes. It's no secret that the world's wealthiest individuals and corporations often pay less in taxes than you'd expect. But how do they do it? What strategies are they using to keep their tax bills low? And more importantly, are these strategies legal? We'll be exploring these questions and more in this video, so grab a cup of coffee, sit back, and let's dive in. Stay tuned as we delve into the strategies used by the wealthy to minimize their tax liabilities. First on our list, the infamous offshore tax havens. Let's delve into the world of offshore banking and explore how it's a popular method for tax avoidance. Imagine a place where your hard-earned money can take a vacation, a place where it can lounge on a white sandy beach, sip tropical drinks and bask in the sun, all while remaining virtually untouched by taxes. Sounds like paradise, doesn't it? This is essentially what offshore tax havens offer, a tax holiday for your money. Offshore tax havens are countries or jurisdictions that provide favorable tax regimes. These places offer low, or in some cases zero, tax rates to foreign investors. This makes them attractive destinations for people wanting to reduce their tax liabilities. The mechanics are straightforward. Wealthy individuals or corporations set up shell companies or trusts in these tax havens, and these entities hold their assets or conduct their business activities. The profits generated are taxed at the tax haven's lower rates, or not taxed at all, as opposed to the higher rates in the individual's or corporation's home countries. Some of the most well-known tax havens include the Cayman Islands, Bermuda, and Switzerland, known for their banking secrecy laws and low or zero tax rates. It's estimated that trillions of dollars are held offshore, a testament to the popularity of this tax avoidance strategy. However, it's important to differentiate between tax avoidance and tax evasion. The former is legal, albeit often frowned upon as it contributes to income inequality and fiscal deficits. The latter, tax evasion, is illegal and involves hiding income or information from tax authorities. The use of offshore tax havens has been a contentious issue, sparking debates about tax justice and economic inequality. Critics argue that they enable tax avoidance on a grand scale, depriving governments of much-needed revenue. On the other hand, proponents argue that they encourage economic activity and promote competition among countries. So, the first trick in the book, stashing money in offshore accounts, but remember, there's more to learn. And as we delve deeper into the labyrinth of tax avoidance strategies, you'll find that the world of finance is full of such intriguing and complex mechanisms. Scene script. Next up, trusts and foundations. Trusts and foundations have been a long-standing favorite for the wealthy when it comes to reducing their tax liabilities. But how do they work? Let's delve into that. At its most basic, a trust is a legal agreement where one party, known as the settlor, transfers assets to another party, the trustee, to hold for the benefit of a third party, the beneficiary. The trustee is legally bound to manage these assets in the best interests of the beneficiary. There are various types of trusts, each offering different tax advantages. For instance, a revocable trust allows the settlor to retain control over their assets and make changes to the trust during their lifetime. On the other hand, an irrevocable trust, once established, cannot be altered or dissolved without the consent of the beneficiary. Now, how does this help in tax reduction, you might ask? Well, when assets are transferred to an irrevocable trust, they are no longer considered part of the settlor's taxable estate. This means that upon the settlor's death, these assets can be passed on to the beneficiaries without incurring estate taxes. Moving on, let's talk about foundations. Unlike trusts, foundations are independent legal entities. They can own assets, enter into contracts, and most importantly, they are typically exempt from income, capital gains, and estate taxes. Wealthy individuals often set up charitable foundations where they transfer a portion of their wealth. Not only does this reduce their taxable income, but it also allows them to leave a legacy, often in the form of philanthropic endeavors. While it's important to note that the setup and management of trusts and foundations can be complex and require expert legal and financial advice, The tax benefits they offer can make them an attractive option for those with substantial wealth to protect. So there you have it, trusts and foundations, a clever way to keep wealth in the family and away from tax collectors. Now let's talk about capital gains tax. Capital gains tax, or CGT, is a tax on the profit you make when you sell something that's increased in value. It's the gain you make that's taxed, not the amount of money you receive. So, how do the wealthy use this to their advantage? Well, it's all about timing and understanding the difference between short-term and long-term capital gains. Short-term capital gains tax applies to profits from the sale of an asset held for 1 year or less. The tax rate on short-term gains is usually higher, similar to ordinary income tax rates. On the other hand, long-term capital gains tax applies to profits from the sale of an asset held for more than 1 year. The tax rates on long-term gains are typically much lower, ranging from 0 to 20%. The wealthy, with their army of financial advisors, play the waiting game. They hold on to their assets for longer periods to benefit from the lower long-term capital gains tax rates. This strategy requires patience and a keen understanding of market trends, but it can significantly decrease the amount of tax paid. Moreover, the wealthy often offset their capital gains with capital losses. That's right, they use their losses to their advantage. If a wealthy investor sells an asset at a loss, they can use that loss to offset gains from other investments, effectively reducing their overall capital gains tax. Additionally, many wealthy investors also use certain types of trusts and investment funds, which allow them to further reduce or even eliminate their capital gains tax. But that's a topic for another time. And there you have it. The wealthy don't necessarily have a secret formula. They simply understand the system better and use it to their advantage. They know when to hold on to their assets, when to sell, and how to offset gains with losses. The wealthy know their way around capital gains tax, and now so do you. Ever wondered why the rich love real estate? Let's find out. Real estate investments are not just about buying land and buildings. They are also about the tax benefits they can offer. Yes, you heard it right, tax benefits. The wealthy have known this secret for years, and it's time we unlock this mystery. Now let's talk about something called depreciation. In simple terms, it's the decrease in value of a property over time due to wear and tear. Here's the catch. Although your real estate property might actually be appreciating in value, the tax laws allow you to claim depreciation as a tax-deductible expense. This means you can reduce your taxable income, hence lowering your tax bill. Quite a neat trick, isn't it? But wait, there's more. Real estate investments can also give you tax deductions on mortgage interest. If you've taken out a mortgage to buy your investment property, the interest you pay on that mortgage can be deducted from your taxable income. Again, this can significantly lower your tax bill. And let's not forget about property taxes and operating expenses. You can deduct the cost of maintaining and managing your real estate investments. This includes everything from repair costs to property management fees. Even travel expenses related to your real estate investments can be deducted. So you see, real estate investments offer a myriad of tax benefits. They provide a legal and efficient way to lower your tax bill. It's like having your cake and eating it too. You get the potential for capital growth and rental income, along with the bonus of tax deductions. But remember, every investment comes with its own set of risks, and real estate is no exception. It's important to do your homework and possibly consult with a tax professional before diving in. Real estate, more than just land and buildings, it's a tax-saving tool. So there we have it, 4 popular ways the wealthy minimize their tax bills. First up, we explored offshore tax havens, those sun-drenched islands where money seems to disappear only to reappear at tax time with a significantly smaller tax obligation. We then delved into the world of trusts and foundations, seemingly benevolent entities that can serve as shields against hefty tax bills. Our journey took us next to capital gains tax, a realm where the wealthy capitalize on lower tax rates on investments rather than income. Finally, we touched upon real estate investments, a landscape dotted with tax breaks that savvy investors know how to exploit. Each of these strategies, while complex, offers a glimpse into the world of wealth management and tax planning. We hope you found this insightful. Don't forget to subscribe to Investor Web for more on finance and investments. Until next time, keep investing smartly.